Hello, everyone, and welcome to the Franchise Show. I hope you're doing well. And this is the show where we get under the hat of some of the most important topics in franchising. And it's a live show. Well, it's live if it's March 11th at 5:15 for about 50 minutes. So if you are here live, then please pop a comment in, get involved in the conversation, and we will do our best to recognize you and answer any questions you've got. And what do? Each week we take a new topic and we take a lovely guest. And this week we have a fantastic guest with us. This week we are going to be discussing franchise resales and exit strategies. And to talk about that, we have the lovely Andrew Marcoux from Businesses for Sale. Andrew, welcome to the Franchise Show.
Thank you. Thank you for having me, Ollie.
You are completely welcome. So perhaps we could start with a little bit of sort of history and how you've come to be involved in our wonderful industry, and in particular, the sort of the resales side of things with your fantastic business.
Yeah, I mean, it's not been the most kind of direct way into franchising. It's been quite convoluted for me. I started businessesforsale.com with my brother over 25 years ago, and we originally had the idea that we wanted simply a gateway to entrepreneurship, and franchising wasn't directly front and center in our thoughts at that time. We just back 25, 26 years ago, the internet was quite young, so no one really fully understood what was happening with it, but we knew we wanted to take classifieds online. So we had a paper-based publication that predominantly focused on businesses for sale, hence businessesforsale.com says what it does on the tin. How creative and brilliant are we? So we effectively focused on that end of the entrepreneur journey, and introduced franchises a few years down the line as an idea to say, well, if these eyeballs are looking for business ownership, getting into the role of running and owning a business by virtue of buying one, then actually franchising is the obvious kind of tangential market to look at. So we introduced that in the early 2000s. We originally had a site called franchisesales.com, which some of your viewers, listeners may remember. And what we've done in the last few years was fold that in directly back into businessesforsale.com, which is quite ironic because originally franchises started on businessesforsale.com before we ported it off site. And we did that because I think it reflects that franchising has become quite a credible and serious business ownership strategy, i.e. people getting into business ownership. It's become very credible for that, and I think there's been quite a sea change. I think once upon a time there may have been a kind of almost a snobbery. Oh, you got to start your business, and you got to chew glass and stare into the abyss and do all the things you got to do to be in business. But actually, it's every bit as valid in terms of being an entrepreneur, running a franchise opportunity, in my view. And I think that's reflected by how the market has grown. And I think that goes down to the idea that it's not just about the idea, but it's about the execution of the idea. What you have to do to make a business work, whether that's the product market fit or the capex that goes into building the infrastructure to make a business work, employing people, having a value proposition defined and understood. All the things that you have to do as a startup, you have to learn really from ground zero. And I've done that as businessesforsale.com, and I know how tough that is. And I've done that with a couple of other businesses as well. You don't get any of that with franchising. You can hit the tire can hit the road at speed and at pace and start generating cash flow, because ultimately cash flow is king. It's the name of the game. It's the ultimate reflection of what you're doing to provide value for your clients and your customers. And a lot of that has been sussed out when you buy a franchise. In fact, it's all been sussed out for you. You then need to put your entrepreneurial strength into delivering on the promise of what a franchise is offering. And I think a lot of people are cottoning onto that fact now. And of course, reselling is effectively your capital windfall when you effectively monetize or valorize the equity you've built up by handing that on to the next franchisee, the next owner. So we've seen that whole market really grow, franchise resales, just simply as a proportion of listings on our site, on our marketplace. There's been incremental, single-digit incremental growth year over year. I guess that reflects as well that the whole franchise market itself has matured, as systems have matured, and people come to the end of their working life within a particular unit of franchise that they need to hand it on.
Yeah, absolutely. No, that's a fantastic introduction. And it's great to sort of hear the story behind how you've got to where you've got with this business and how it's come to be and how it's evolving as well. Before we get a bit deeper into today's subject, we've already got lots of people here live, so it's definitely the time to introduce and recognize everybody who's here with us live. We have Shannon Wilburn, CFE, with us, and Shannon's put happy to be here. Well, we're very happy to have you here. Looking forward to hearing your thoughts on exit strategies, resales, and how we can approach that. We have Irene Moscardo. Forgive if I mispronounce any of your names. And Irene's put hi. Well, hi to you too. We have the lovely Natalia with us. And Natalia is a regular with us here on the show, and she's put great topic. It certainly is. It's a topic that I think is really, really important. In fact, I think it's vital for our franchise businesses to consider resales, exit strategies. It's part of that bigger picture. It's part of that capital win that Andrew was talking about. And I think it's really important for us to get into this. Who else have we got? Oh, we've got Johnny with us, Johnny Joseph. Johnny hasn't been with us for a while. Great to have you with us, Johnny. You are always welcome. Johnny's put good morning, afternoon, evening from a rainy Los Angeles. Well, it's fantastic to have Johnny with us. Johnny is a franchise auditor over there in America. So it's always fantastic to have your thoughts on any subject, but I think this will probably be a good one for you. We've got Millie with us. Good to have you with us, Millie. Millie's put hello, everyone. And Millie, of course, works with yourself.
Yes.
Lovely businesses for sale. So great to have you with us, Millie. Looking forward to hearing your thoughts. We have Rachel Schaffer with us, and she's put live or live. That's our beautiful language. We don't know.
It works either way for us.
It's
we're living and being live. Yeah,
that's exactly it. Let's have a look. We've got loads of questions. It's really important. These conversations are a conversation between us all. They're a conversation with the industry. So for me, you're the producers and directors of this show. So it's ultra important for us to recognize everyone that's here. So Tim's put, good evening, Harvey and Andrew. Great to be here. Exit strategies are one of my favorite topics. Franchisees should always be encouraged to think about what their exit looks like for them. We're going to come back on this one, actually, Tim, because I think that's a great one to start our conversation off with.
Yeah, it's a great question, I think.
Before we do, let's just make sure we get all these other people in. Andrew, you've proved to be incredibly popular, so there's lots of people who are here. Well, we've got Luke, of course, another superstar from Businesses for Sale, and he's put good evening, or good evening to you too, Luke. We have somebody who was with us last week as well. Good to have you with us, Raisa. And she's put hello all from the MENAT region. We talked about that last week. Great to have you with us. We have the ever wise Simon Wise, and he's put hello, franchise friends. Well, hello to you too. Looking forward to hearing your thoughts. And we've got one more person. Let's recognize them. And we've got Louise from the Netherlands. Always good to have you with us. Looking forward to hearing your thoughts as well. And welcome, of course, to the Franchise Show. So let's get into this. Let's put Tim's comment up, Andrew, and see what we do with this.
Well, I think it's an absolutely brilliant question to ask to open up proceedings here, because you've got to think about the exit before you make the entrance, I think, a lot of the time in business ownership, because it really is about as much the exit and how you're going to get there to the exit. So there's the old cliche, you know, never get into a room without knowing how the hell to get out of it. And, you know, that's certainly the case with making any investment in life, and buying a franchise is making an investment. It's all about putting a pound down to know what your return on that pound will be. And that goes really to the heart of how businesses and indeed franchises end up being valued in terms of cash flow and what cash flow is being generated. So you've got to see franchises, businesses as entities in their own right that are cash flow generating organisms, if you will. So yeah, the kind of realization that, you know, a franchise may not be forever, that you will potentially own it for a certain period in your life. It might be because you're aligning your passions with a particular time in your life with what you want to be doing, spending your time. But ultimately, it has to be financially viable, and you need to realize that wealth is going to be generated, or anticipated that you're going to be generating wealth while you're running that franchise. What I find really fascinating, touch upon what I said earlier, is that actually franchises have really become a very credible source of investment opportunity, a return on investment, because of that idea that you can go from relatively a slow start to something that's up and running very, very quickly. And of course, if you're buying a resale, then you're buying something that's already got proven track record. You're buying something that has not only got the support of a brand and a system behind it that gives it that prestige and momentum, but you can buy it with confidence that will continue if you were to step into the shoes as the new franchisee. And because of that, there's a relatively low risk or de-risked element to making that investment, which in turn can actually raise the value of the valuation, which is quite interesting, because I think looking at some of the statistics and looking at some of the modeling, working against what we have with ValueRight, which is our proprietary valuation system, which is a cash flow valuation methodology that we use with ValueRight, that there is an uptick in valuation when franchises are involved. And I think that's because of those reasons of the lower risk involved with buying a franchise. You're buying that system. You're buying the wider entirety of something. You're buying into that culture and into the value proposition that's embodied in the system of a franchise. And I think that's a very good and wise investment decision. But you know, there are other factors that need to be taken into account. You know, not all franchises are made equally, and not even franchisees within systems are made equally either within the same system. So what are those factors that you need to kind of tease out as a prospective buyer to understand what is driving cash flow? In traditional kind of non-franchise business valuation, I think it counts for valuation in all types of businesses, including franchises. You know, you need to look at growth. How is growth happening with the business that can be extrapolated from the history of the business's cash flows? Making sure you have a nice sticky returning revenues from a cohort of customers that are loyal to your proposition. That is always very good. And not ensuring that you're not having most of your revenue coming from a small cohort of your user base, of your client base. Again, these things are universal in valuation. If you line the stars in in all these things in business, you can get at that higher end of multiple of that cash flow, which is the name of the game. And there's other things you can do to ensure that you get the best version of that cash flow when the exit comes. But it's all about preparation, isn't it? If you're looking to sell your business, you've got to ensure that all the things that you need to have in order with your business are in place. And that is no less true with obviously financial hygiene, making sure the lease and the contracts and things like this are in place, employee contracts are in place, ensuring that you understand the impact of when you do sell your franchise. What's the transfer fee? Every franchise is different, it seems, from what I understand. And there may be viewers on the call here today that can contribute to that.
Absolutely.
What's the transfer fee? Because that actually impacts you as a seller, how much cash flow you can then pass on, and that can be then monetized or valorized as a multiple, right?
Of course, absolutely.
And that's something that traditional businesses don't have. But notwithstanding even that, I think the benefit and bonus of selling a franchise on outweighs some of those negatives too.
I mean, you make so many great points there. I mean, I said to you, and I say to everyone, I genuinely start off with nothing written down, but I always end up with a huge amount written down, because genuinely the things that you're saying there are of value to me, and they're of value to anyone that's listening that's in our industry. Because I'm going to go back, and we've got a few comments coming in, but I'm going to go back to something you said, which I think is a valid point to start. You said, think about the exit before you make the entrance. And I like that as a phrase, because if you are a prospective franchisee listening to this and you're thinking, okay, right, I want to invest in this business. Not enough franchisors talk about the end, because they imply a negativity to that, perhaps, or they just don't want to discuss it. But it's so important, because like you say, it represents their journey. You also said something there, preparation, right? If your exit strategy is, let's say, to grow to 5 sites or 5 locations, whatever the business is, over, let's say, a period of 5 years, and then sell as a resale, there's a plan that you need to put in place to make that attractive for a resale. If your plan is to grow to 50 sites and sell to private equity, that's a different plan. And I suppose there's people that want to perhaps pass on a business to a family member. Maybe they're of an age where they want to just pass it down to a son or daughter. And therefore, it
bit of a touchy subject at the moment, Harvey, with our Chancellor introducing IHP on the business succession. But point taken. Yeah, absolutely.
Yeah, absolutely. Let's have a quick look, because we've got a few questions coming in. Let's see what people are making of this conversation so far. So we've got Johnny coming in with this. From a franchisor's perspective, it's important to consider whether a franchisee royalty audit should be performed before a sale or transfer of a franchise takes place.
Absolutely. I mean, that's an outstanding liability that needs to be settled in advance of any sale. And that falls squarely on the shoulders of the incumbent franchisee, doesn't it? That they need to keep a clean set of heels when handing on the business. And that's absolutely right. So if there's any outstanding royalty fees, I mean, I think you wouldn't necessarily be selling any of the liabilities on anyway, typically when the new franchisee takes on. But contractually speaking, there would be an obligation to make sure that the handover, at the time of handover, that no outstanding liabilities are in the air at the time. So it's a very good...
You said about they're getting things in order, didn't you? Financial hygiene, contracts in place, and this would firmly fall into that category to make sure that things are in place from a franchisor or from a franchisee's side of things. And if you're getting into a business, you'd want to make sure all of those things are in place. If you have just joined us today, this is the Franchise Show, and today we're talking to Andrew, and we're talking all about franchise resales and exit strategies. It's been a fantastic conversation so far. And we're going to get straight to another question. And I like this one, and I think this is what we're really getting into this conversation now. And I like this one by Amit. Welcome to the show, first of all. And he's put, how do you value a franchise business? Revenue growth versus EBITDA. I guess it's unique to the business and the model. You've mentioned a few things, but how do you go about answering this question?
And typically, I mean, there's so many factors involved with determining what the multiple will be of that cash flow. But revenue growth, if growth is happening, and you can see things on the top line, and it's also falling to the bottom line, because revenue growth doesn't necessarily mean increasing cash flow if you haven't got good cost control in place, right? It may be coming from the top line and going out the back door because of bad cost control and the like. So it really always comes down to the growth of the cash flow. That's a really key important point there to make. So what we look at typically is something called seller's discretionary earnings, which is effectively EBITDA plus, and it's plus to do with your own earnings as a take home as the owner operator, if you are the owner operator, in terms of you taking cash out, because obviously that's cash that's going to go back into the business. And then there may be other discretionary costs that may be being taken on by the franchisee. You may be putting your car through the books that new owners might not necessarily do, or you may be putting your children's phones through the books. Who knows? All sorts of things can end up happening in terms of perks. But the idea is to try and understand and tease out that cash flow detail. Now, our value right calculator effectively does that. It kind of asks the right questions to elicit, to draw out the kind of cash flow modeling, if you will, and understand it better, so that you can get to that final seller's discretionary earnings number, which is a form of cash flow, which is very much in the guise of the owner operator, because you are effectively the owner operator as the franchisee if you are running it as a single unit. Different valuation models when you have different cost concerns when you're doing multi-unit. So there's another level of discussion there. But the principle's generally the same. And I think the idea is that if you can show that if growth is happening and that you can find the right sector and the comparables within the sectors, because each sectors have a different multiple based on the nature of say the franchise industry. I think that is an important point, partly because it tries to reflect the stickiness of the revenue, the type of customers that may be being sold to, etc. So there's different sectors will run differently. For example, gym memberships are very sticky revenue. They're subscriptions after all, and SaaS type business models are very, very attractive because of the annual recurring revenue dimension to how the revenue models itself. And there's plenty of franchise examples that work in that space too, with web design type or app type businesses and franchise opportunities now, where there is a recurring revenue from hosting fees and from maintenance fees, etc. So building for scale in that way really counts in your favor. But all in all, most businesses will have a SDE multiple between 2 and 5 times, right? So as short as 2-year return versus 5-year return. But that's, there are exceptions to that rule, okay? I'm talking very broad brushstroke kind of rule of thumbs here rather than edge cases. And I think what's quite interesting about business valuation is that, people see the stock market, they look at the PE ratio, which isn't exactly the same because you're looking at equity rather than enterprise value, but nonetheless, it's an indicator. People see, Google's at 30 times multiple. Why can't my business be at 30 times multiple? Well, they look at Tesla, which even after the ridiculous bloodbath that's gone on recently, is still trading at something like 100 times. It effectively takes 100 years to get a return on that investment. they work on a completely different economics of typically what SME type businesses will work. And I've just spotted a question by Shannon there about distressed businesses. I think it's a really good question there. If there's no cash flow, you have to work on asset valuation and actually look at what the assets are worth, not what the cash flow that's being generated by those assets. And that's being generous as well. But then you're kind of talking in kind of liquidation territory there in terms of understanding what each component, effectively stripping something for parts. There can be a goodwill value as well, above and beyond that.
Just briefly stopping you there, in case anybody is looking and isn't aware of what the term distress means in a business valuation. Just briefly touch upon that. Is that where a business is in trouble and they're perhaps in administration, but they're trying to sell that business? Is that where that term comes from?
Yeah, it means there's not enough cash flow in the business. I mean, if you think of cash flow as effectively the lifeblood of any business survival, when there's a scarcity of that, i.e. your outgoings are exceeding your incoming, you have effectively a negative cash flow situation. Then you are effectively starving the business of its life force, cash. And then at that point it becomes distress. Now, distress, you can get loans and you can get credit, etc., to help stave off the distress, and that's to buy you time to get your business back on its feet, to recover, etc. But that's what that means.
Yeah,
it's the oxygen of life, of business. Cash.
It is, and we think of cash sometimes in that form of folding pieces of paper, but of course cash. Yeah. Again, this is really interesting because when we talk about EBITDA plus, net profit, all of these different terms, right, to try and describe the bit that's left over, after you've been running a business, there are so many different ways. It can be confusing. I mean, is there an industry standard to try and get to that?
If you look at DCF, which is the discounted cash flow, which is like the gold standard of all valuations. If you do valuation for M&A at one of the big business schools, you're going to more than likely do it about DCF. If you're a big swinging CFO at a big blue chip company, you're going to know inside out what DCF is. What they start with is something called free cash flow, which is something that itself has different interpretation of how you get to free cash flow. But the idea there is to look at actually how much cash is being generated by a business after all expenses have gone out, even taxes and everything else. So you're looking at that prime number. I mean, to me, there's a pretty clear definition of what free cash flow is, because it's an absolute number that drops to the very, very, very bottom line. Typically, right to the bottom, where you've got to know what to do with that money. There's only three things you can do with the money when it falls to that bottom line. You can either reinvest it back in the business to grow it. You can either use it to buy other businesses, or you can return the capital, right? Which through dividend. So we're talking about that kind of cash at the very, very bottom, that ultimately you're going to be handing over to someone else. Now, where there's different interpretations are things like, well, do you include depreciation or amortization of assets, because that impacts cash flow. It's an accounting treatment of how something's been bought, but how does that impact actually the cash flow situation? So there's kind of a mismatch there. We've spoken about seller earnings, the owner's earnings and owner's benefits, whether you're employing people in your family for the sake of employing people and spreading, they're lowering the tax liability because you're spreading the income around. That happens a lot, of course, in family-related businesses, and all that comes back in as cash. So all that needs to be teased out, and that's where the interpretation gets quite complicated and quite murky. And what we've tried to do with Value Right is build a tool that kind of gets to the raw numbers in hopefully a user-friendly way as possible.
Absolutely, absolutely, and we'll talk a little bit more about how that works in a moment. But we've got a good amount of comments coming in. I just want to make sure we recognise people and see what our community has got to say about this, because it's a fascinating conversation. I want to welcome Leslie Flowers to the show. Leslie runs a fantastic live on Fridays based on the book Think and Grow Rich, and she's put, I find this particular live is really good and choice information for me in general, while I know it's focused on franchisees. Leslie's always a big advocate of this show, that it's interesting to people even outside of the business of franchising, and that means a lot. So thank you for that, Leslie. Let's have a look at this one. There's a big old comment. It's not going to fit on the screen, but let's read this one. I just spoke at a franchise conference, and they had a stage speaker talking about how to exit. So smart. At our conference, we had this topic as a round table during that time for franchisees that want to exit. Also, I attended Neighbourly's training, and it was one of the first topics they talked about. Well, look, it's great to know this is something that's being talked about, because I think in franchising, we need to be open, we need to be transparent, and we need to talk about the good, we need to talk about the bad, and we need to talk about everything, that whole journey. An exit strategy is so important. Like you say, if you don't know where you're going and you don't know what where your exit is, you can't make that entrance. So yeah, love that. Let's have a look at this one. Natalia's put, passing down is not guaranteed. Yeah. Any buyer must be approved by the franchisor, and it is important to ensure franchisees understand that in order to avoid tears. This is a really good one, and I'll be interested to see what you make of this one, Andrew, because it is a bit unique to our franchise businesses, isn't it?
It can, yeah. I mean, I only know anecdotally. Being publishers as we are, but I fully understand that that is actually baked into the franchise agreement in terms of the stipulation of how the franchisor having the final say. They also have usually first right of refusal on maybe buying a franchise back, a franchisee's territory back into the fold, etc. So there's numerous kind of stipulations and hurdles, if you will.
Yeah.
But that makes total sense, doesn't it, for the franchisor to ensure that it's not just down to the franchisee finding a prospective new buyer, that the franchisee, the franchisor themselves can make sure that they have the right experience, have the right financial credibility, creditworthiness, etc., and that they're going to fit culturally within the wider family of their franchise system. So yeah, it's as a buyer of a franchise, you've got to, again, as part of that exit, understand what the hurdles are to know that you need to clear before you can actually sell something. And it may not be fully and solely in your hands, and it won't be if franchisor approval needs to be sought in the first instance.
Cool. Are you finding that when you're getting these valuations, are they coming from franchisees, or are they coming from a franchisor that's helping a franchisee, or is it a bit of a mixture?
It's predominantly franchisees using it because they're hunting around, they're doing their discovery. So I think most franchisors have their own valuation models. They have to, and they work with potentially consultants and people in the know. So there's a couple of brokers out there, intermediaries that focus on resales that you may be aware of, Harvey. And these people are specialists, if you will, of understanding the valuation models that may be for particular franchises in particular industries. So there's almost a kind of subculture now that this part of the industry is getting so big that specialist know-how is needed for third parties. So, but generally we do work directly with the franchisees, but it's incumbent on the franchisee selling the franchise to know what the hurdles are. Right. Again, that's all part of the exit strategy. So before you get into that room, understanding how you're getting out, making that exit, understanding what's in the franchise agreement that impacts you and your ability to sell your franchise resale is pretty vital, I'd say.
Absolutely.
So Natalia's absolutely right on that.
Yeah, 100%. One of the things I was going to ask, I mean, obviously, if you're an existing franchisee and you're interested to know the valuation of your business, then it's a good place to begin. But if you're a new franchisee looking at a particular franchise opportunity, do you find that you get potential investors using the software, or can they do that to sort of find a valuation and see what that could be?
No, the valuation's done on historic precedent. So
Right.
in terms of new territory, I mean, that's a really key point to ask for buying a new franchise opportunity is, well, what is my return on my investment? How long will it take for me to get the return on that pound, against the initial franchise fee, the working capital that I need to put into the equation, obviously the margin that's hit as a result of the royalty fees and other fees that the franchisor is going to want from that. So as I understand it, a lot of franchisors would obviously do a lot of modeling as part of the sales pitch to really clarify that. And then you have to work out, effectively reverse that into a valuation model to understand, well, actually, how long does it take for me to get a return on my investment? Because ultimately, that's what we're talking about here. And what we're looking at in the future is, how long does money take to come back to me? And if you look at something like the DCF model, it's all about future revenues, okay? And it's all predicated on the opportunity cost and the risk, etc., of what it would take for that pound to come back to me and how long it would take. And as a rule of thumb, the lower the risk, then the bigger the valuation, because it is all about risk and reward and the balance of that. So, I mean, having that conversation with the franchisor as a prospective franchisee, looking at the numbers and really try to drill in and understand the modeling of how the money moves, and seeing how your investment come back to you is very important. It's just as important as obviously being passionate about the sector that the franchise is working in, etc.
Yeah, absolutely. Happy, successful franchisees. We often talk about that. I want to get to a few comments here because we've got some fantastic comments coming here. These conversations are always so interesting to me. Shannon's put here, we created a resale guide for franchisees who were ready to exit. So helpful for them to set expectations. What a brilliant thing. I think all franchisors listening to this should be considering doing it. If they haven't already, should be considering that resale guide so that, people can know what the process is and they haven't got any big surprises when it comes to that part of that planning. I love it. Before we get to some more questions, and we've got a few more that have come in, Andrew, could you give us a sort of a brief description as to how the platform sort of works, how long it takes to get a valuation? What does someone do when they reach out on that platform?
It's quite an involved process. I mean, valuation, it's a bit of a mudsling between art and science. And what we've tried to do is get the best of both parts of the science part, which always goes back to the financials, the cash flow and teasing out that, but also understand the kind of more art side of the narrative around the business's circumstance, where it is in the wider world of business, because business don't work in isolation. They are deeply immersed in a context that has an impact on what that value is. So we try and tease out what we call factors in terms of the circumstance of the business, its location, its revenue modeling in terms of understanding the customer concentration, as mentioned before, ensuring that not too much revenue is coming, say, from one client. Looking at the competition of the landscape, teasing that out, ensuring how many other units maybe of competing franchises or even non-franchise businesses within your marketplace, because that all has a dynamic. So there's an incredible amount of factors that need to go in before you can come out with a calculated estimate of what the value is. So that's kind of trying to tease out the more analogy, kind of non-binary, non-numerical aspects of a business's circumstance, to try and tease out some of that detail, to then impact what the value is. So a typical valuation on value right could take up to a good part of an hour, but this supposes is that you've got all the numbers in at hand as well. So they're having, a good clean set of accounts, management accounts to hand,
Yes.
maybe referring to your accountant or someone that understands business jargon of, well, what is depreciation, what is that amortization, in terms of what that actually is in terms of a charge on your P&L, etc.
Yeah, absolutely. That's the one that always gets me on EBITDA, the amortization or whatever it's called, and that's the one I think, people have got to understand whether maths and whether accounts is your thing. You've got to understand this because this is important. This is key to what makes up a valuation. And this is key to a strategy if you want to sell something and have that win with the capital.
That's right.
Yeah.
And the assets like, stock at valuation, when you're making a valuation, how much stock are you passing on to the next owner? That's a huge add-on in terms of actually being able to valorize that. So yeah, there's quite a number of factors and vectors that you have to go through to understand that detail. And the devil is always in it.
Of course, yeah. I'm coming back to something that Natalia said here. One view on a distressed business is that a business that should never be sold less than what a green site would cost. I suppose you could get a situation in a franchise business where, things haven't gone right and it just hasn't got any value up and beyond the revenue that it returned whilst it was being run. I suppose, do you encounter situations like this?
Well, you can get to a point where a business, there's a bit of a cliche that says, oh, every business can be sold for the right price. And I think at some level that's true. But if the business takes more money to run it, to keep it in existence, then of course it's more than valueless. It's actually negative value because it is actually sucking money out of you rather than making you wealth, creating you money. And some businesses end up being in that position without a doubt, and they go into liquidation. And it might be that with some franchises, some franchise sites just simply do not work for what you're trying to do in that part of the world. I'm sure there's plenty of examples of that. That your viewers are going to be far better placed than I am to talk about.
Definitely.
But that can happen because that's the nature of business. There's no guarantees in business, and just look at the raw stats. 7 out of 10 startups will fail at their 3rd birthday. Right? That's some serious Darwinian kind of survivalist action going on there. And I don't think that the thing about franchises though is that it does protect against that, because the assumption is that if a franchise has been around for a long enough time, that the brand has been built up and the value proposition has been refined and the product market fit has been worked out, then that risk of failure is greatly reduced. And that valuation, therefore, of a franchise resale, certainly a franchise resale that is cash flow positive and is cash generative, will have a premium against it. That's my view.
Yeah, of course. Yeah. And the stats for franchise businesses are much healthier. There was a recent BFA report on it, and people are probably going to correct me if I'm wrong, but I believe it was somewhere around only 10% of franchise businesses are failing. 9 out of 10 are succeeding, and there's some great stats. And I think that's why banks are keen to get involved in the franchise industry. And, you've made some really interesting points about how the valuation of franchise businesses, the de-risking, can make a really healthy valuation. We're nearly at our sort of final section today, but I do want to touch on one thing. One of the things that you were talking about in terms of evaluation was growth. And it's a big word and a big subject with lots of different roads and avenues in it. But how do you approach a business that has plateaued, but let's say it's cash healthy, it's a healthy business, but there just doesn't seem to be any growth? It's not declining, but it's plateaued. where does that stand on evaluation?
Well, there's two routes you can go by. You can, and it's in the context of a franchise, which, on the potentially negative side, you are restricted in what you can do in terms of pivoting or growing your product set, as a traditional like non-franchise business might be able to do to grow their revenue. The other dimension will be to obviously cut your costs and make sure cost control is optimal, that there's no waste, and that you're constantly reviewing how your costs are being allocated in terms of your resources and your money and your energy, etc. But I think for me, if you're plateauing in a franchise and you're a single unit franchise, the obvious next thing to do is to buy another franchise site to grow your kind of wider revenue streams. It's as simple as that. And you see that time and time again. Someone starting with a single site plateauing because they've maximized what is possible within that territory for that product proposition. And it is then working out, well, what costs have to be taken on in terms of management in lieu of you being the franchisee. But that's a wholly different that's kind of a growth strategy, not necessarily a franchise exit strategy. And that has probably a different topic conversation. But there can only be sometimes a finite amount of money that can be made from a particular product in a particular market. Yeah. If it's as simple as that. But what you're relying on with a franchise is that the capex, the research and development, the innovation is happening above you. All that is effectively outsourced to HQ and the product proposition. Yes. So that to me is actually another great reason to get into franchising, that the burden of growth effectively isn't squarely on your shoulders as the franchisee. You're effectively outsourcing that risk, because it's always risk. R&D is huge amounts of risk. It's expenditure without any, it's a calculated expenditure to work out whether there's going to be a return on that expenditure in 6 months, 12 months time, etc., as you augment your product market fit. So my recommendation would be is to make sure you align yourself with a franchisor that is always thinking that year, 2 year, 3 years ahead with its product offering. And what are they doing with innovation? What are they doing with R&D investment? How are they using their profits to make sure that the product range that you're selling and service range that you're selling effectively on their behalf is always going to be tip top and at the leading edge of the market? And we've seen that in technology all the time. Especially with the advent of what AI is bringing to bear too. And
of course, yeah, 100%. I think you're absolutely right. Look, we've got some great questions. What I'm going to say is we do get to these afterwards. Andrew is still going to be here. He can look at these questions later on as well if we haven't got to them during the live today. And we have got to the last part of the show, and it's a fun bit, the last bit. So we are going to be stopping talking about franchising for a little bit. I'm going to have to turn my camera off because nobody is allowed to see me without a hat on. Okay, it's one of the rules. But I have a hat on again now, and it's a beauty, isn't it? Look at that stylish hat. And we have come to the point in the show which is brought to you by PJ Murphy and Son, bespoke British hatters, and they made this beauty for me. So thank you to the wonderful Paul Murphy from Flip Out for making my hat here. Now, this is the part of the show where we are going to ask Andrew a little bit about him personally. Perhaps something that people don't know about you, a claim to fame, someone famous you've met, and then you get to ask me a question.
Yeah, I really want to write a musical.
Oh, love it.
And I'm a hobbyist pianist. Got to be careful how I say that. It's lucky enough early in the evening. Yeah, so yeah, I'm a hobbyist composer actually, and I do write a few show tunes that one day may see the light of day. Who knows? But I am so tied up and so engaged with what I do with my day job. it may just have to stay a pipe dream, or one day when I cash in the chips and sell, maybe I'll have the headspace and desk space to do these sort of things. But yeah,
absolutely. And you know where to go to get a good valuation, don't you, Andrew?
Yeah, for the time being, that's what I can do.
Oh, I love that. I really love that. Wow. Well, we will watch out for this musical coming in the future. And look, this is also where you get to ask me a question. I hate this bit.
Well, I'm quite intrigued by you, Harvey, because you've come to franchising relatively late in life. You've had other incarnations of life. And what appealed to you? What was your motivation to get involved with the wider world of franchising? Running this show and being incredibly passionate and frankly caring about the industry. Where's that coming from?
Yeah, it's a great question. It's something that I haven't been asked. I have come to franchising late. I'm new to franchising. I'm not new to life, as you can see. And I think, like a lot of people, I sort of fell into franchising. I sold catering equipment for a lot of my life, including to my beloved Coffee Republic, and found an opportunity. And because it was late on in life, and because I was and I still am new to franchising, I wanted a way in which I could learn. And by doing this show, I hoped that the conversations would add value. But I also hoped that I would learn. And my goodness, do I learn. And I had to learn at a rapid rate as well. And it's another reason why I do it, and why at the end I've got, all of these pieces of paper with notes. I think also it keeps me curious.
Yeah.
Because I don't know, I'm never going to preach to people. So I always want to listen and learn from other people. So I think that's the reason.
And it's such a rich and diverse world, isn't it? It's like the full spectrum of business life is out there with franchising. And so and there's always trends, and there's different kind of movements within the industry. So it never sits still, does it?
Definitely. And you know what? And I've only been in franchising a couple of years, and I don't think I've ever said this about another industry that I've been in, but I can't see myself not being in franchising. It's a world that I love, and it's a world that people seem to really support one another. So I'm just keen to make it as good as it possibly can be. So that's, I think, the reason. So look, we have come to the end of today's episode, because I don't like to keep people too much longer into the evening or afternoon, wherever you are. But let's have a look at what we are doing next week on the Franchise Show. So next week on the Franchise Show, which will be Tuesday the 18th of March, we will be talking to the lovely Neil Muttock from Evolve, and we're going to be talking all about franchise tech. So it's going to be a good one. There's all sorts of areas within our businesses that we use technology, and it's going to be a great discussion. So please join us next Tuesday, 5:15 GMT. 12:15 EST for that. So I'd like to thank everyone who's been here with us live today. These conversations are what they are because of you. You're the producers, the directors, and I love it. And I thank you a huge amount for that. And I also want to thank you, Andrew, for being our wonderful guest today and supporting the show as well. I really
welcome.
Appreciate it. And I've loved the conversation. Thank you so much.
Thank you. Thank you for having me, Harvey. It's been
my absolute pleasure. So until next week, my friends, take very good care. Cheerio.